From the following receipts and payments account, we are required to prepare income and expenditure account of CD Club. Now students, the information given here includes receipts and payments account of CD Club. On receipt sides, we have balance brought down, subscription, donation and entrance fees. On payment side, we have purchase of furniture, salaries, postage and stationery, entertainment expenses, we have books and balance carried down. Plus there is an additional information in the form of outstanding for postage and stationery is rupees 200. Now students, whenever we are required to prepare income and expenditure account, we have to make sure that only the revenue items appear in income and expenditure account. Plus those items which relate to this year only, that is the accrual concept. So let us start with receipt side. Balance brought down represents the balance of cash. So it should be shown in the balance sheet, not in the income side. Then coming to subscription. The total amount of subscription that we have received is 12,000. It is very clearly mentioned that out of this 12,000, 1,500 and is for previous year and 500 is for 2003. So let us deduct them because they do not relate to this year. For 2001 and for 2003. We'll deduct 1,500 and we'll deduct 500. So the net receipts for this year or the income for this year is 10,000. Right? Then donations. Nothing is mentioned. Donation would be considered to be an income for this year. By donations, the amount would be 2,000. Next is entrance fees. Again, since nothing is mentioned, entrance fee would be considered to be income for this year. It would be a revenue income. So entrance fees is 1,000. Now students, coming on to the payment side. The first item on the payment side is purchase of furniture. Remember, furniture is a capital asset. It is an asset, long-term asset. So it is a capital item. Hence, it would not be shown on the payment side. It is not an expenditure for this year. Then we have salaries. Salary is a revenue expenditure. So salaries would be 2,000. Then we have postage and stationery. Remember, amount paid for postage and stationery here is given to be 800. Plus there is an adjustment also that outstanding for postage and stationery for this year is 2,000. So that means whenever we will create or make an entry for postage and stationery, it would be 800 for this year that has been paid plus outstanding of 200, which makes total expenditure on account of postage and stationery to 1,000. Then we have entertainment expenses. To entertainment expenses, and this is given to be 1,000. Books in any case would be considered to be your assets, hence would not be recorded here. Lastly, balance carried down represents the closing balance of cash, so it would not be recorded here. Now we have made all the entries, we have posted all the entries from receipts and payments to income and expenditure account. So let us find the surplus or deficit. Remember, in case of non-profit organizations, the motive is not to earn profits. So any excess revenue that we get is written as surplus and any excess expenditure that we make is written as deficit, not loss. So in this case, the total of the income side is higher, which is coming to rupees 13,000. Out of this 13,000, 4,000 would be deducted and would be written as surplus. That would be 9,000 and the total would be 13,000 on both the sides. Remember, this surplus would now be added to the capital fund. In some cases, some authors also write this surplus as excess of income over expenditure. Now, continuing the same example with some different adjustments. You are again required to prepare income and expenditure account of CD Club, which shows subscription, donation and entrance fees on the receipt sides. And the payment side has purchase of furniture, salaries, postage and stationery, entertainment expenses, books and balance carried down. The adjustments here are subscription outstanding for the year 2000, depreciate furniture at 10%. So now students, starting from receipt side, remember only revenue items would be transferred to income side. No capital item is adjusted onto the income side. Balance brought down. Balance brought down is not entered here because it represents cash balance. Then subscription. By subscription, we have received 12,000 for the year. But out of this, 1,500 and 500 relate to 2001 and 2003 as mentioned here. Minus for 2001, for 2003, that is 1,500 and 500. But to this amount we will add outstanding for this year, for the year. I'll write it as outstanding at end, which is given to be 2,000. So the amount again comes to 12,000. Then students, we have donations. Donations are our regular receipts. Nothing is mentioned. These are general donations. So by donations, we are receiving an income of rupees 2,000. Then entrance fee. By entrance fee. Entrance fee is also receipt for this year. Nothing is mentioned, so it is a revenue receipt. So 1,000 for entrance fee on the income side. Now coming to payments. The first payment is purchase of furniture. Remember, furniture is a long-term asset, so it would not be recorded here since it is a capital item. But we have an adjustment, that is depreciate furniture at 10%. This depreciation is a regular expense. Why this depreciation is not appearing on the payment side? Because it is a non-cash expense. Since it is a non-cash expense, it cannot be shown in receipts and payments account as it is prepared only on cash basis. But income and expenditure account is prepared on accrual basis, and this depreciation is an expense for this particular year. So to depreciation on furniture, it is an expense. 10% of 5,000 would be 500. Then we have salaries. To salaries, 2,000. Then we have postage and stationery. To postage and stationery, 800 rupees. Then we have entertainment expenses. Entertainment expenses, rupees 1,000. Then books, no entry is made for books because they are assets. Now students, let us total it out and find the surplus or deficit. In this case, income side has higher total. So let us total it out first. $15,000 is the total on the income side. Out of this, we'll deduct expenditure. The total of the expenditure side is 4,300. So on deducting, we'll get surplus 15,000 minus 4,300. That will be 10,700. And the total is 15,000. Remember, this surplus would be added to the capital fund in the balance sheet, and it represents excess of income over expenditure.